Good morning. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Efficient Market Advisors. We are a business of Cantor Fitzgerald Investment Advisors. This is our weekly economic and market commentary for the week beginning Monday, May 7th, 2018. The presentation you're about to see and or hear has been prepared by EMA for use with investors and financial advisors who are each expected to make their own investment decisions. Nothing contained herein should be treated as investment advice, nor is anything herein a recommendation for the purchase or sale of any security. With that, let's begin. Last week was mixed for equities, the S&P 500 finishing the week modestly lower after a big rally on Friday, but small and mid-cap stocks were higher, about a third of a percent. International markets, which would have been closed during our part of our trading hours on Friday because they're basically a day ahead of us, particularly for the Asian markets. We're down on the week, but it's likely that we'll see some follow through to the upside from them at the beginning of this week. Large cap international equities down about 0.5%. Emerging markets down a bit more, about 1.7%. In the world of fixed income or bonds, interest rates were basically unchanged on the week. We saw a nice little move higher in the longer dated treasuries as we backed back below 3% on the 10-year. Bloomberg Commodity Index was the winner on the week and is now the winner on the year almost. Small cap a little bit higher, but commodities now up 2% on the year as signs of inflation are percolating into the economy. We also saw the HFRX Global Hedge Fund Index is down about 1% year to date for the period ended Thursday. Getting into some economic data and releases last week, we received personal income and personal spending and personal income for the month of March. Income rose 0.3%. That's identical to the February rise. Consumer spending was up 0.4%. And on a year-over-year basis, personal income is up 3.6, spending up 4.4. Both signs of a very healthy economy. Taking a look deeper at the one thing that's going to become more and more important, especially to the Federal Reserve FOMC committee policymakers, is the rate of core PCE, personal consumption expenditure inflation. The Fed has a mandate from the Congress to maintain price stability. Price stability is defined by the voting members of the Federal Reserve currently as 2% year-over-year core PCE inflation, which we hit. 2% is there. So we have hit the Fed's inflation target. Now, there was some language in the Fed statement last week from their meeting to suggest that they're looking at more of an average, and 1 month at target or above target doesn't seem to make too much of an impact. That encouraged investors to believe that the Fed would not raise rates too much too soon and choke off the economic recovery. All that being said, this is a metric we want to watch closely because if inflation spikes unexpectedly higher or significantly above the Fed's 2% target, we could be in for some greater than anticipated tightening by the central bank. We also got the Chicago PMI rose slightly to 57.6. Anything above 50, that's the green dashed line on your screen, says that business activity increased in the month. Now, the rate of increase was a little lower than it was a few months ago, and we did see a negative sign from the new orders component. We'll have to watch next month and see if that gets reversed. Pending home sales rose 0.4% after a very big increase in January, which was in response to a big decrease in January. Year-over-year basis, pending home sales doing quite well. Getting into some of the manufacturing and non-manufacturing PMIs, we've got both the market readings and the ISM readings are competing metrics. So competing data points that attempt to measure similar, if not the same thing. The market manufacturing PMI rose to 56.5 in April, suggesting that the recovery in manufacturing is actually accelerating. Taking a look at their non-manufacturing or their services reading, that rose from 54.0 to 54.6 for April, suggesting an acceleration in the rate of economic growth there as well, all of which kind of feeds into this concern about inflation kicking above 2% and causing the Fed to raise to slow down that. ISM, however, which is a competing metric and actually has kind of been around longer and is sort of more widely followed, ISM says not so fast. It expanded. It expanded at a fast pace, but that rate of pace is actually shrinking, at least when it comes to manufacturing. They came in with a reading of 57.3. That's down from 59.3. In the report, though, we did see information that suggested that higher prices for raw materials and shortages of labor are putting a damper on the ability of the economy to continue to expand. The services sector, which is far bigger than the manufacturing sector, here we did see that PMI fall to 56.8. Now, construction spending fell 1.7% in the month of March after gaining in February, still higher, significantly so from a year ago by about 3.6%. Private sector did fall 2.1. Looking at private, the residential construction was the big decliner, 3.5, but on a year-over-year basis, still doing well. But the private spending on non-residential fell much less. So there's a little bit of concern and watch here on residential construction. Obviously, new home sales and existing home sales can be very much dependent upon interest rates. Interest rates are a big price component to the purchase of homes, obviously, because most are purchased with a mortgage, and interest rates on mortgages have kicked slightly higher here in recent months. Automobile sales came in at a nice 17.2 million annualized pace. Now, getting into labor, was the first week of the month last month, so we have a number of jobs reports. The first, though, we do have our regular weekly initial claims for unemployment. Came off the 49-year low to 211,000. So we're essentially or basically at a 49-year low in initial claims for unemployment. And given the fact that our labor size, the labor force, is as big as it's ever been, these claims as a percentage of the labor force certainly are at a historic low. So it's a historic good time, I guess, for labor. 4-week moving average fell, lowest level since 1973. Now, the two big reports, the automatic data processing, or ADP. This is the payroll company that maybe issue your paycheck. ADP came in and said that in the month of April, the private economy added 204,000 jobs. That's on top of 228,000 in March. Sixth consecutive month above the 200,000 level. It's a very, very good sign indeed. Of course, the other side of that coin is the upward pricing pressure on labor. Now, the government puts out a similar report. They have competing statistical methodology. The Bureau of Labor Statistics puts out a report, and they say that, well, in their model, they think that jobs grew by 164,000, but they upped their March number to 135,000. That was originally reported at 103, so you still got about a 200,000 add. Unemployment fell below 4%, down to 3.9% for the month of March, even when the participation rate, because the participation rate was down from 62.9 to 62.8. If you wanted to take sort of a little bit more pessimistic view of these jobs numbers, which are very good, you would want to look to that participation rate and say, really, if the participation rate were higher, 65, 66, 67, then a 3.9 or 4% print would be a better thing. Although there are significant demographics at play right now because people are living so much longer, but they're not necessarily in the labor force. That's bringing that participation rate down. We also have the baby boom generation now firmly into their retirement years, which brings that participation rate down. Some people would argue that lower participation rate is a sign of a weaker economy. Some would argue that it's more of a demographic shift. We tend to think it's a little bit more on the demographic shift side. But we're also seeing productivity kind of flatlining. Unit labor costs, though, do seem to be on the rise. They rose 2.7% in the first quarter after a 2.1% gain in the first quarter. That suggests a tightening labor market as opposed to that sort of in or out of the workforce issue. Average hourly earnings also starting to trend a little higher, finally. up 0.1% on top of a 0.2% gain in March. Now 2.6% higher than a year ago. And if average hourly earnings are up 2.6%, then that's rising, increasing the standard of living, obviously, for the nation's labor. One of the other things that's a big metric that seems to be very important to the president has been the balance of trade for goods and services. A trade deficit is a subtraction from GDP. Imports subtract from GDP, exports add to GDP. And for many, many, many decades, the U.S. ran a pretty big trade deficit, but it was always primarily attributed to our petroleum trade deficit because we imported so much of our energy and oil. That's not the case so much anymore, but with the economy growing, people getting wealthier, having more disposable income, they seem to be desiring more imported or foreign goods, and that, of course, can drive that trade deficit higher. It did, however, in the month of March, fall significantly, fell 15% from that 57.8. Look over on the right-hand side there. It does not a trend just yet, but it fell to 49 billion. Exports rose 2%, add to GDP. Imports fell almost 2%, also an add to GDP. That sent the GDP forecast number for Q1 up pretty significantly last week. We look at the GDP Now forecast. We're also now about 80% of the way through Q1 earnings, and of course these numbers are coming in, continue to come in really, really well. 312 out of 407 reported companies have beat the consensus estimates, and as such, we're seeing the consensus estimate for earnings for the remainder of 2018 continue to increase. 90 companies came in negative. If you look at the earnings growth rates, I mean, energy's coming back, it's up 95%, primarily due to the rise in the price of oil. That's more of a cyclical thing. There's not a lot you can do about it. But healthy gains in things like materials, industrials, a lot of this has to do with the new tax law that was passed, obviously, in December, went into effect in January. But even staples are up 10%. Real estate, which has been a kind of a poor performing sector, contains a lot of the REITs, the real estate investment trusts. Even they're up 7.8% despite facing some headwinds of higher interest rate expense. Technology continues to just do very well, and financials up about 27%. Now, I was having this conversation with one of our analysts here last week. We were talking about the number of companies beating, and somebody said, well, companies seem to beat all the time, and then earnings get revised higher. I said, well, let's go back and look over the last few years, and we found this piece in a Deutsche Bank report that came out. He said, look at the last few years when this happened. What was that beat, and what was that increase in that consensus estimate for earnings? Normalizing it at 100. Now we're getting close to $160 a share right now in the S&P 500. But this one is extraordinary in its scope and size and rate of increase, at least when compared going back over the last couple of years, looking at these different quarters. So it is certainly a very, very good earnings season, and that's why I think you're seeing the market sort of find its bottom, seems to have found its bottom around that 2,600 level. And we're getting close to about 2660, 2670 now. But it seems that we've now bounced off that 2,600 level about 3 times. Now, okay, I'm optimistic. I feel good about the economy. The labor market's doing good. Corporate profitability is doing well. Some geopolitical tensions seem to be easing. But we do have this issue. If we have a shrinking trade deficit, believe it or not, that's related to our budget deficit. Because when foreign countries have more of our currency because of the deficit we ran with them, they can use that currency to buy our treasury bonds, which finances our budget deficit. And when you look here in 2018, the far right-hand side of this chart, you see that the U.S. has a financing need. It needs to sell bonds this year in an amount that's close to 25% of GDP, gross domestic product. That's the highest of any of the major economies around the world. Now, you can see they broke it into 2 parts here. This is also from a Deutsche Bank piece. The budget deficit, which is expected to be extraordinarily large, and that's unusual for a time of economic expansion. You want to save your powder and run your deficits at a time of recession or, worst case, war. But the U.S. is not doing that. Instead, we're deciding we want to go for the gusto. We want to go for more growth right now, and that carries with it some significant risks. In addition, without the Federal Reserve, they're buying, in fact, actually reducing their balance sheet. You can see that that should put some pressure on bond prices and some upward pressure on interest rates. And that seems to me to be the biggest risk to our forecast and our performance ultimately in 2018. This week, we've got plenty of economic data from consumer credit on Monday. PPI and CPI both coming in this week, along with inventories, jobless claims, import-export prices, and consumer sentiment. Really nothing too major. We're going to see continued earnings this week, and then we'll move on from there. As always, I want to thank you for tuning in. Appreciate you being a part of this. We'll talk to you again next week.